Welcome back. Welcome back. Another Hump Day Real Estate with Kendell, DMV. We'll wait a few seconds here. We got a guest that should be coming in. Uh, we had this guest before, Miss Laura. There she is. Miss Laura is entering the building. Hey, Miss Laura.
Hello.
We welcome you
How are
back
you?
again.
Awesome. Thank you so much. I love
Another-
being on your show.
Another Hump Day.
These weeks are going by so fast, and I think somebody stole the heat because now it's chilly.
They completely stole the heat, and summer forgot all about checking out.
There you go. It's just like, wow. It's
Oh.
supposed to be like in the 40s or something tonight.
Well, I'll tell you, while we on the topic of weather, let's give our blessings to those folks down in Florida going through whatever they're going through right now. A lot of folks, I've seen it on my Facebook feed, must have taken vacation, and they're in the mix of all that bad weather down there. So let's send our thoughts out to those folks.
Yeah, definitely praying for them. And I touched base with a couple people that I know to check on them and see how they're doing, feeling, because it hadn't really hit yet, but that was this morning. But yeah.
Yeah,
Sounded though like they really have their game plan on board, and they already have services lined up to come in as soon as the storm passes. So
I wish I could show. Let me see something. Let me see if I can do this real quick. my son is funny. He's down in Orlando. This kid is funny. So let's see if I can show this. It won't work. I guess that won't work right. Well, yeah. So that won't work. So
it was a little fuzzy. I couldn't make it up.
Yeah. So what he, so he has, what is the thing called that the kids play in a pool? What is the little, not the life thing, but whatever they play that you blow up?
The inner tube?
Yeah, like the inner tube thing, right? So
like an inner tube?
He blew up an inner tube, sat it on top of his car and said, I'm good. I went and got this. So I guess
maybe if you put it under his car could float.
Well, that too, but then the next reel on Facebook is him pulling a shot at tequila. So I guess he got it covered.
One way or the other.
One way or the other.
God bless people that have electric cars, because once those pumps are underwater, no electricity. You definitely want to avoid that. That's a bad combo.
Yeah. So we thank you again for jumping on and sharing some time with us. Today, we're going to talk about this thing everybody's talking about, arm. I thought they was talking about somebody's arm falling off or something, but apparently it's an adjustable rate mortgage out there or something that the folks are talking about. Tell us a little bit about that arm thing.
Well, I don't think we've talked adjustable rate mortgages in the industry for well over a decade. Well, more than that, because before the crash.
Yep.
And we have not spoken of adjustable rate mortgages. So we have fixed rates, which your rate is fixed for the whole term of the loan. Mm-hmm. And then you have adjustable rate, which means your rate is not fixed. It adjusts according to some predetermined, disclosed pattern. So you could have a 1-year adjustable. I don't know how many of these have come out. I haven't done a full body of research on them, but they're definitely going to be out there. So we used to have a 1-year, a 3-1 arm, which meant it was fixed for the first 3 years, and then it adjusts annually after that. You could have a 5-year arm, so it was fixed for the first 5 years, a 7-year arm fixed for the first 7 years, a 10-year arm fixed for the first 10 years, and then turning to that 1-year adjustable. You can also have like a 10-6, so that it would be fixed for 10 years and then adjust every 6 months. So it is disclosed to the borrower with a schedule of what their payments are going to look like. When it switches to the ARM, the schedule would show worst case scenario. So it would show the maximum it could move, because it will have a annual cap as well as a lifetime cap. So it could, from like a 10-1 arm would adjust annually after the first 10 years. And then it would have a first year adjustment, an annual adjustment, and that life cap adjustment. So it tells you exactly how it's going to maneuver in the future.
All right, so I'm itching a little bit to ask this question. I wanted to wait until you finish everything and really talk about this thing, but it's itching me. What's the hardship with the adjustable mortgage when you compare it to the way rents are increasing? Or what I'm saying, because if I know we went away from it because that I believe that was a whole thing that played a part in it in that recession in 2008. But I'm just thinking, like, okay, yes, you got an and it reset. Unless you lost your job or something like that, which is still kind of questionable to me, because it's still, even if you lost your job and you had to go back out there and find another job, if you are renting, that year ends or your lease, it's going to still go up 10% or whatever. So is that thing really as bad as what they say, or is how you feel about that?
Well, from the types of adjustable rate mortgages that we had before the 2008 crash, a lot of people took what was well, they were coffee arms, or which was a cost of funds index, and those had negative amortization, where you were not paying a full payment. You actually had payment options. So you could make the negative amortization payment, which was less than what you owed. You could make the interest only payment, which was just paying the interest, or you could make a principal and interest payment. So it actually had options on how you could pay your mortgage every month. And that's not a bad loan. It was originally designed for a very sophisticated borrower who was usually putting down a very large down payment. They didn't actually need a loan, but they wanted to have a loan for financial and tax reasons.
Okay.
And that's who that loan was intended for. And then they started going crazy with it, and they gave it out to borrowers that it was not originally designed to serve. And then they made it so that mortgage product was available to everybody without any down payment, and with people that had lower credit scores, and it just got nuts. It got literally insane what they offered. And that's why that was a bad product for most people. It wasn't really a bad product, it's just that they allowed it to be used for a consumer that it wasn't really intended for.
Yeah, but even go ahead
on that, but we don't even have that product anymore. We don't have negative amortization loans.
Okay.
So when you have an adjustable rate mortgage, the rate is not fixed. It's fixed for whatever that first initial time frame is. So you know what your rate's going to be, and the rate will be below what the 30-year fixed rate is, because it's not fixed for 30 years. It's only fixed for 1, 3, 5, 7, or 10 years. So it's going to be a lower rate. So you're starting out your life with your new mortgage at a lower interest rate and a lower payment. That's the real purpose of an adjustable rate mortgage, because presumably you're picking the time frame fixed for the period of time you expect to be in that property.
Yep.
And you're kind of using it to save money because you don't plan on being in the property more than 10 years. So you take a 10-1 arm.
So what if you are though, and then you get to the 10th year? My thing is that I'm thinking is this, that okay, the interest rate may be higher or lower, but if my car blows up, I go out and I gotta buy a car, especially right now in the day, it's gonna be more expensive anyway. So I mean, why I'm just stuck on why are people really
Yeah. So when the when the product starts the adjustment period, it usually can only go up by 1 or 2%.
right?
We're not talking about a particular product, so we're being a little broad here,
Okay.
but it's only going to adjust a certain amount. And you're going to know in advance, because not only do they disclose to you before you purchase the loan while you're in the processing of your loan, but they're going to disclose it to you a couple months prior to the adjustment taking place. So they let you know, and you already knew because you knew from when you decided to take that loan product. So if it only adjusted 1 or 2%, your payment might not have changed that much.
Mm-hmm.
And the adjustments can be up and down. It's not a one-way,
Yeah.
street there. It
Right.
can go up or down depending on the index. So there's two things that come up with what that actual rate is going to be when the adjustment period hits. You have the margin, which is a fixed amount, and that margin represents the profit to the lender,
Mm-hmm.
covers their expense and their profit. And then you have the index. The index is the part that changes. So it's an index that's tracked mathematically. It's a number, and it's usually it can be prime, it can be the 12-month average T-bill rate. It can be there's a new rate. It used to be LIBOR was a big one, but now they changed that out with a new one, but I can't remember what it's called. So these are rates that they track, and then they average them out, and then they know what your index is going to be. So if your index is a very slow moving index, your rate's not going to change that much. It's
Mm-hmm.
going to move very slowly up or down. If you have a more volatile index, like prime would be an example of a more volatile index, because prime tracks with the Fed funds rate, and that they can change every time they meet, like they have been lately. They've been going up 0.75 for the 3-4 times now.
Mm-hmm.
So prime is much more volatile index than some of these other ones, like the 12-month treasury average would be a much more slow moving index. And you can look these things up, you just Google them, and it will give you the history of that index. And a good lender like myself, I would thoroughly explain to you exactly how this works. Now, over the whole 30-year term of a loan, historically speaking, an adjustable rate mortgage doesn't tend to cost you any more than a fixed rate. It's just that people get afraid, and if it would keep them awake at night, that their mortgage is not fixed in, then take a fixed rate. If you're a little more open to that ability to potentially save money, or you're only going to be in the house a certain amount of time, and you're making some financial plans, and it's advantageous. If there's a big margin between the adjustable rate and the fixed rate, then maybe an adjustable rate is good for the person. So sometimes with the 5-year, the 7-year, and the 10-year, we can qualify the person on that start rate
It's
instead of the full rate.
Do you think that was one of the problems in the earlier days, that when people were taking those
Pose.
arms, they were taking the shorter length arms and not so much playing with the long ones? Could that have been part of the problem?
Well, before the crash, yes,
Yeah.
those coffee arms, the Nagam arms, were fixed for 3 months. They had an introductory rate at like 1%. And
Yeah.
then it started adjusting after 3 months.
Wow.
You know, that was, and like I said, those were loans that were not meant for us average bear people. It was
Well,
meant for people that are super financially savvy, and they didn't really need a loan, but they were going to take a loan for tax purposes.
well, I guess the problem with that was is that it was allowing maybe somebody who probably only could afford a $200,000 home get a $500,000 home.
Well, yes, because instead of qualifying them, they were doing them on stated income loans. And then they opened up stated income loans from just self-employed borrowers to W-2 people. So you didn't have to show your W-2s, and you could just say what you made, which was nuts. They did, and then they were selling them, and they were derivatives and all sorts of back end stuff. And Wall Street got a big appetite for it because some big Wall Street fat cats were making billions of dollars, and then
Because of those
the
charges.
little house of cards that they built came tumbling down.
Most of
But
those
we're not
loans,
doing none of that is available, and
most
can't,
most of
it's
those
not
loans have
happening.
prepayment penalties, or no these days.
Most loans do not have prepayment penalties. We have a few portfolio products that do have prepayment penalties, but it's fully disclosed to the borrower.
Gotcha.
But the vast majority of loans do not have prepayment penalties.
Gotcha.
And there was a lot of other things with the crash that it was that perfect storm thing. It really wasn't just the loan product.
Hmm.
You know, it wasn't one thing. It was many, many things all came together to create that ginormous mess.
Yeah, it just seems to me like a couple of people that I heard, it was just like, wait a minute, I got a surprise. This rate changed on me, and now my life changed. Like, well, guess what? If you if this so happened to have been in the rental market at the same time and your family grew and you couldn't stay in the 2 bedroom anymore, you had to go to the 3, your life would have changed. So it's like, it's like what I tell people these days. I'm like, you just have to go out and find more money. I mean, there's
Yes.
literally nowhere, no other way around it. Like, you got to go and find more money. It's like,
Life happens to all of us, and we all have rainy days and, mountains to climb. And there was a lot of consumerism going on there that was way out of hand, that
yeah,
also contributed to the crash, because people were cashing out on their equity in their home and gobbling it up for consumer purchases.
right.
And so they maxed out their mortgages, and then when the value of the house pulled back during the crash, then they didn't have any more wiggle room to make any adjustments.
Buying luxury cars and stuff. Like,
It
wait,
was
instead of
total, it was total, like, full tilt consumerism.
it wasn't a thing of, hey, I'm successful. I made $1 million this year. I went out and bought this car. No, my equity went up 150,000. I can go get a HELOC now and pull 80% of that out. I'm going to get 2 new cars. Like,
Yeah, and they had home equity line that went to 125% of the value of your house. So you could go over and above the value of the house. So there was a lot of very crazy things happening that was allowing consumers to consume and be gluttonous. And but those products shouldn't have been out there. They weren't good for the consumer. And then,
But
it was just like,
but there's a lot of things that's not good for the consumer, right? Consumers have to start using their own mind.
and hopefully it will not come available.
I think you got the internet connection got unstable, so I might have missed what you were last saying. And
yeah, there's yeah, it's slow. It's going slow.
Okay. Yeah, what I was saying was we can blame it on the business owners all day, but the consumers still have to use their mind, their own minds. Like you have to mindset, like what does this actually mean that I'm now going to go into my house and go and buy two $50,000 cars? And I'm a single person, and I'm just going to now go and splurge and buy two cars and just be okay with that situation.
I 100% agree. Like all of us have to take responsibility and be responsible for the choices we make. Because the more responsibility we take for our own choices, the bad ones and the good ones, but when we take responsibility for something, we have the ability to control and change it.
Yep.
If you don't take responsibility for it, you're just giving that control to somebody else to make the decision. And then you're just like a leaf blowing in the wind. You're subject to whatever the whim somebody else has. And we all make bad decisions, all of us. We've made tons of good ones and tons of bad ones. And the best thing to do is take responsibility for all of it and learn the lessons that are there for us to learn, and don't do it again.
I want to pick on some folks though. Like, how did you at that point? I don't even think we were mainly talking about a lot of the younger people that were actually doing these things. These were people that I believe knew better.
I think just some inside their gut, they knew better, but everybody was having fun, and there was just, like I said, it was like a free for all. It was a consumerism frenzy. It was like Pac-Man. What was the next thing you could gobble up? You could get.
I'll have that fun when $1 million drops into my bank account, and then I'll just go. And then I know that whatever written document, I'll read that thing, make sure I read all the fine print, make sure I don't have to owe it back or whatever. Right? I won the lottery. And then I'll go.
Well, my customers that asked me for that product, I said, you have to come into my office. I have to show you exactly how it works. I could hand calculate all the changes. I could explain it to them forward and backwards. And then I would say, then I'm going to have you sign a disclosure that it's my professional opinion that you should not take this product because I'm going to offer you this other one. And some clients, I just said, I won't do it for you. And they're like, well, so-and-so will. I was like, that's great, but this is not the product for you. It's not good for you. It's not meant for you. How are you going to eat? Did you want some meat on your plate when you sit down for a meal? If you make $50,000 a year, you should not be buying a $500,000 house. How can you afford it? It's just not sensible. Well, my Aunt Sally's going to move in and Uncle Joe is going to be in the basement. Well, what happens when they leave? That leaves you. You're the only one on the mortgage. You can't pay it. So, and then some of them got mad and left, but I was like, I don't want to make any lengthy explanations at the pearly gates. So I want to do the right thing and explain to them and educate and inform. And that's the way it rolls. Basically, I know plenty of people that made a lot of money those years. I made good money, but because I can't put somebody in the wrong product.
But you asked a question. Half of those people, are they even still in the business today?
Probably not.
And if they are in the business, how well are they doing in the business because they can't operate like they once were before? Made it easier to operate, to get in front of, because it's much easier when you just have a product and you just run around and get in front of a whole bunch of people and a whole bunch of people accept that product, right? It's a different ball game when you have to get in front of the people and you have to educate and earn their trust, right?
Yeah, it's totally different now. But I always love the education and the information part because I love the math, because the math tells the truth. And I love showing people the math, and then they can make an informed decision, which is perfect. But I think we will get to where the ARM adjustable rate mortgages are priced well enough, and that differential between the adjustable rate and the fixed rate is enough of a gap that it will be financially
feasible.
A good decision to take the adjustable rate mortgage.
Yeah. I really wanted to get on and talk about this because I think that again, the folks need the education piece of this thing, right? Not just, you know, because people are talking about it's coming back and all of that stuff. They need the educational piece to know what happened when it came around before, an idea of why things happened the way it happened. You know, it's just like, you know, the last 2 years or so, you know, the mortgage, the real estate markets spiked like crazy. But what people had to understand is that we wasn't dealing with a 2006, 2007 spike in the real estate. It's not the same thing.
Also, what very few people have talked about, we actually had a dip in the population that was in that majority population, first-time home buyers, the 28, 35 years old. There was actually a dip because of back in the early 70s, actually Roe versus Wade got passed, and there were less births. So 30, 35 years later, we had a dip in that first-time homebuyer population, and that actually coincided with the 2008 crash.
Wow.
So you had more supply of houses and less buyers. Nobody talks about that, and that actually contributed to values going down because you had fewer buyers chasing more goods. So that brings prices down.
And then the tail end of that is going into 2009, 2010. You still don't have those buyers. You still don't. Now you have all your people that probably want to sell. They won't sell because they're scared, but because of what happened.
But a lot of people said, "Oh, now my house is worth less money, so I'm just going to let it go." People did what we called strategic short sales. They didn't really have a hardship, but they just didn't want to stay in their house because they're like, "Oh, my house dropped 50%. I have to move. I have to give it up." And you know, they made that choice to do that. And that contributed, people dumping houses contributed to the supply when you had a lower demand. So all of these things added into the pile of junk that was going on, and it just, the mess got bigger and bigger and bigger.
You know what I never actually got to understand or see what happened to? What happened to the shadow inventory? They never talked about that ever again. It was supposed to be shadow inventory. Banks were sitting on all this stuff, and 10 years or so later, we're still having the same inventory problem. Where's that shadow inventory? What did they do? Stick it in a warehouse somewhere?
They shrunk all those houses down, and they're stacked on little shelves. And that is not true. This is not like the Twilight Zone, or what was that show? Was it? It wasn't FX. What was it? Well, anyways. You can tell how old I am. Talking about the Twilight Zone. Nobody knows who that is.
We watch a little Twilight Zone.
So, but you know, there was a lot going on back then, and you know, now we have a housing shortage, and we have more buyers. You have more buyers getting out there to buy, and maybe they'll take advantage. We also have the buy down, where we buy down your interest rate for like a 3-2-1 buy down. So it's 3% less for 1 year, 2% less for the second year, and then 1%.
Now that's on that. Now that's with your regular financing though, right? Not with the adjustable rate mortgage.
Yeah, that's on a fixed rate, but we actually take monies that the seller would contribute and buy down your interest rate so that you kind of start lower and then you go up a notch and up a notch. So you can kind of gradually like work your way into being comfortable
Gotcha.
with that rate.
Gotcha. Now, what about now we had a couple of discussions about what these buyers should be looking at and doing out in this still crazy market, because things are just shifting, but things are just still a little crazy. Give me your little feedback on how you feel about what you think these buyers should or shouldn't be doing.
Well, I think a lot of buyers have to erase your mind about HGTV, perfect. It's TV camera, everything's pristine. There's no dinks or dents. It's a house. People have lived there, and it's not going to be perfect. What you want to find is something that's structurally sound, has great bones, the house has good flow, and it's physically located in the neighborhood you want, because you want the school district, or you want, it's walkability, it's near the things that you like to do. And then you move in, and you, with your own personal creativity and by saving money, you get to update, upgrade, maintenance, and renovate, maybe one project at a time.
And that's
You
even if it
become
doesn't. Go ahead.
you become a Home Depot, Lowe's warrior. You take their classes, and then you do a project in your house, and you get the pride of ownership. But you need to get in the game. You need to become a home owner. Your landlord is not updating your house. They're maybe not even maintaining it, from some of the people I talk to.
Mm-hmm.
It's not in the neighborhood you want to be in, because that's why you're talking about moving. But you won't move because you won't find something perfect. Life is not perfect. It's bumpy.
And what does get in the game actually help them do? If they get in the game, what is the benefits of that later on down the road?
So when you make your mortgage payment every month, part of that mortgage payment goes to principal. And that means your loan is going down a piece, a chunk, like a bite, every month. So you get that equity building because you're paying down your loan. And then the second way you're going to be making money on your house is houses appreciate. It's not a straight, steady line. It's, can go up and down, but they appreciate, which means they gain value over time.
Mm-hmm.
And we're still expecting in most areas 3 to 5% appreciation. So if you bought a house at 200,000, and it went up by 5%, it would be worth 210. Plus you would have paid down money. So we would have 15,000 more equity after just 1 year. So you're gaining. That's like a savings account. It's an asset. It's not a liquid asset, but it's an asset. Also, the money that you made as your down payment, say you made 3% or 5%, that money went from your savings to an asset now called equity. So you have your initial deposit, your down payment, which is equity, plus every month when you pay a chunk of your principal, that's more equity. And then as the market gives you appreciation, you have even more equity. So it's a savings account that's growing and growing and growing, month after month, year after year. So when you get into your first house, say you stay there 5 years, and your house has appreciated 5% every year, or maybe one year it was 3% and one year it was 5.5 and the next year it was 4.1. You know, you have on average 20 some percent. So then you sell that house and you have maybe now a 10% down payment to go towards like a bigger house. Maybe you even have 15%.
And you
And
might have gotten into the market where it's a little slow and the house you dreamed of is right there and you have enough cash to put down to buy it.
yeah, but you cannot get to your dream home if you don't get into your starter home. You don't get to start the race at the finish line. You start the race at the starting line with the starter home. And even a dream home is not perfect. Even new construction is not perfect. They walk around at your walkthrough with blue painter tape and put little things on the wall and nail pops and dinks and things that they didn't cut properly so that they fix them. So even new construction is not perfect. Nothing's perfect. It's just good, great, or as good as you make it. And when when you buy it, it's yours. It's not your landlord's. It's yours.
Yep.
Hallelujah. Get in the game.
So we're almost running out
You
of time.
can't win any game that you don't play in.
You got it. You got it. Well, we're running out of time, and as always, we love having you. Tell the people once again how they can reach you. You don't have your screen up behind you now.
I know, I didn't have my billboard behind me. So I'm Laura. I'm with Nations Lending. My number's 301-674-7716. You can find me on Facebook, on Instagram. Go on the YouTube channel, Laura.fournier. I have tons of good information in there, some of it with Marcellus. And tomorrow afternoon, I have a Zoom that I'll post the link. I'll send it to Marcellus too. And we are going to talk about money mindset. So if we change our minds about money, we can get more of it. And that's what we're going to talk about tomorrow.
And another thing, tomorrow at 7 p.m., I'll be sending a link out. First home buyers webinar that Laura and I are actually hosting. So another Hump Day Real Estate with Kendell, DMV. We thank you again, Laura. And we most definitely will see you tomorrow. But folks,
yeah, we'll see you tomorrow.
Enjoy the rest of your week, and we'll see you soon.
Can't wait to help all these people get in the game.
Yes, ma'am. Have a good one.
Bye-bye.